Hey everybody, coming to you live today from a golf course here in Aptos, California. Thank you for joining us this morning. It's November 12th at 9 a.m. Pacific Coast time. Today we're going to talk about a trend that we're talking about the government bringing up as a proposal around a 50-year loan term. Trump and Mr. Pulte believe that this 50-year term could be a benefit for consumers and first-time homebuyers and create affordability. Well, I'm going to show today why I don't think that's a good idea, and it will be basically some really cool information to show you very simply what we're looking at. So as you can see here on my screen, you're going to be looking and comparing a $500,000 loan on both a 30-year fixed loan and a $500,000 loan on a 50-year loan. The difference here showing that the 30-year fixed is at a 6% rate. On a 50-year term, there's more risk associated with that type of loan. The longer the term that's fixed, the less opportunity that the bank has more money to adjust their rate to make more money. So remember, banks aren't in the interest of being a nonprofit. They are trying to make money. So in this example, you'll also see that we're comparing the difference in rate, again, of 6% to 6.25% on a $500,000 loan. What does that mean? That means that the monthly payment difference is from $2,997.75 down to $2,724.86. What the most important thing is there, that's not a huge differentiator to create affordability, in my opinion. So these are the APR rates, by the way. 6% and 6.25 is the APR in this example. So please be aware that the government's talking about this thing being a revolutionary way of making loans affordable, making homes affordable. If you look here, the difference is about $260, $70 a month. That's maybe 2 dinners out nowadays with inflation. So what's really important to see is that the biggest feature here that they aren't talking about is the total payments you're going to be making over the term of the loan. So on a 30-year fixed term, you're going to be paying $1,079,190.95. Of that, the total interest paid, we call that the TIP, TIP, would be $579,190. That is the total interest paid on the life of the loan. So if you pay off the loan sooner, you would have less interest. But we always want to look at the loan balance over time to determine what it could be in a very worst case environment. Here is the 50-year fixed option. On a 50-year fix at 6.25%, you're looking at the total payments are astoundingly higher. $1,634,918. The total interest difference is over double, or right about double, I should say. So why would it be a good idea to get a 30-year fix? Why would it be a good idea to get a 50-year fixed versus a 30-year fixed? It doesn't make any sense. It doesn't make any reasonable logic. It would just mean you're paying more money. And as some of my friends like Tristan would, and all the appreciation is going to go to one person, the bank. So what is the point of doing a 50-year loan? In some other countries, you will see that there are longer-term loans, but those homes are normally legacy properties that stay within generations of families. So those debts are normally longer. And as we remember, the word mort stands for death. So a mortgage is a device, financial device used for the life of a borrower or till death. That is the definition of mort in its Latin sense. So please be aware that what looks to be a benefit, it really is a bad decision if you are looking to buy a property. And as the stats came out last week, the average age of a buyer right now is 40 years old. That is substantially pretty high. So in any of these options, it really would put someone in their family in a very bad situation if they were planning to keep a property for the long run. Now, things happen in life, and maybe someone's not looking to stay in a property for the long run. Still, I don't think the difference of interest expense in this example of 6% to 6.25% is worth having when you can just get a 30-year fixed loan? And to bring up one more thing I want to share is basically when we're thinking about loans, what we want to think about is the actual payment, total payment, and flexibility in that payment. So what I want to share next is an example of a interest only payment versus a principal and interest payment. And the key there is to think about what cash flow difference you can save by having a lower payment. So in this example I'm going to share next, we should be seeing a little bit of cash flow relief, again, with the flexibility of having a cash flow payment break temporarily. No matter what you borrow, you're going to be paying interest on it. So realize you're just kind of kicking the can down the lane there. So in this example here, we're going to show, again, it's going to be a interest only payment. I used the exact same rate in this example. So at the top here, you'll see two lines, an orange line and a blue line. That simple difference is if I had no principal being paid or if I paid down the principal and interest over the life of the loan. So I like to show this visualization for people to understand that cash flow is something to manage when you're buying a home, especially if you're upsizing, downsizing, or buying for the first time. It's all about making sure that you can make the payment, that it's affordable, that it makes sense, and that it's for your goals, not the bank's. Remember, this is about you, your clients, your goals and objectives, and those are way different than mine or a bank or anyone else. So always study the differences between options you have available. And if you're not sure, a more conservative approach with a lower payment that allows you flexibility to pay more down the road. So in this example here again, you'll see that a 30-year fixed interest only has a difference in payment of $497. That to me is enough to make a car payment, to pay down credit card debts, to put money in my 401k. Maybe look at other things that I can do with that $500 roughly in payments. So what I'd suggest doing when you're looking at this stuff is really look at the differences between the cash flow, make sure you're making a good decision buying a property. And again, always make sure that you are looking at what's best for you. So in this example, again, you can pay a principal interest payment, you can pay interest only. Whichever way you look at it, you have the flexibility every month of paying more money. And how you do that is by recasting. Recasting allows you to make a large payment, normally once a year, to lower the principal balance and readjust the payment versus refinancing. So that's a great hack to learn about. Again, recasting your loan allows you flexibility to lower the payment, to lower what you have to make on the long run of the total interest paid, and gives you control. So always try to get a little higher loan balance. Always try your best to make sure that you're conservative. And again, always think about your decisions before you make them with local relationships, local lenders, local real estate professionals that understand your goals, not the bank's goals. Thanks for your time today. Have a great Wednesday and happy Veterans Day to all those veterans. Thank you for serving our country. And that's another edition of TN5's Mortgage Minutes. See you next week. Stay tuned for more. And I'm off to go play golf. Take care.